G'day folks, Jim here from Orchard Forex. It is Monday the 4th of May. Well, the month of May has begun with an early reversal in the stock markets and also a weaker US dollar. Whether this continues remains to be seen, but right now they both do look to be under some downside pressure over the next couple of days. In terms of data, the main focus in midweek is going to be on the RBA and the Bank of England meetings, albeit that the interest is going to lie in the statements and the outlook from the banks, given that they've already pumped a vast amount of emergency liquidity into their respective economies. The ADP and US official unemployment rate will be released on Wednesday and Friday respectively. The numbers are off the scale but are also largely expected, so the outcome is going to be a bit difficult to predict. The ADP figure is expected to be around 13 million, while the non-farm payroll number is expected to show job losses of around 20 million, with the headline unemployment rate rising from 4.4% in April to around 15–16% this month. Absolutely staggering. But we'll go and see if we can glean anything from the charts out of all that. Okay, we'll start off with the stock markets and the S&P futures, which have just opened Monday morning in Asia. As you can see, we've started, this is Friday's close, we've started with an opening gap lower here. We're 30 points off Friday's close at the moment, and things don't look very special at the start of the week for the stock markets. We had the decent run up over the last couple of weeks. Let's go forward to a 4-hour chart. So we've had this decent run up, and now we saw a decent sell-off, 2.5% or so on Friday. We're now sitting right on the 23.6% FIBO of that run-up, as well as the 50% pivot of this whole drop here. So we should see some support around here. But if we go through 27.80, it looks like we're heading down towards these sort of levels, sort of 27, sort of 55, and then back down here, 27.20 or so, ahead of a potential drop down toward below 2700 to the 38.2% FIBO level. Now the 4-hour charts do look heavy. The dailies likewise. So I think in the short term at least we're going to be under further downside pressure. Having said that, the weeklies are trying to recover, and an awful lot depends on risk sentiment and how things develop in the States. The US states are trying to open up, but with 20 million unemployed or so, it's hard to see the stock markets rallying too far in the next few days. So my own view is that we're probably stuck between the 100 week and the 200 week moving average for the time being. Levels there, and this is quite wide. So it's 28.80 on the top side to sort of 26.70 on the downside. I wouldn't be surprised just to see some choppy trade, but I would rather be selling rallies at this point in time, looking for a test to the downside. But overall, I'm not that bearish, but we have to wait and see how things develop. And I think overall we're into probably some pretty choppy times. Okay, so looking forward to the FX markets and the dollar index. This is a daily dollar index chart, and as you can see, the daily indicators do look a little bit heavy. So I think we might be in for a bit more downside for the US dollar. Having said that, the euro's got plenty of problems of its own. So given that the euro is a big weighting of the dollar index, I can't see the euro heading an awful lot higher, but I think in some choppy trade we could go and see a test back above 110, maybe to 110.50. I'll show you a euro chart in a minute. But the dollar index certainly looks like it could test these lows down around here, and the 200-day moving average down about 98.30. And if we get below there, then we could see a bit of an acceleration to the downside. The weekly charts, we'll just go forward there and have a quick look at that. They've been trying to run higher, but kind of run out of steam over the last few weeks. So there's not very much to go on there. As I say, I think 109 to 110.5 might cover it for as far as the euro goes for a while. I wouldn't get too excited either way, but possibly just trade the range. So we'll have a look at the euro chart. Okay, here we are with a daily euro chart, and as you can see, the indicators look mildly positive. So I wouldn't be surprised to see a retest of this 110.20 to 110.50 area over the next couple of days. But like I say, I can't get too excited on it. The weeklies are pretty neutral, as they were with the dollar index. So, and the 4-hourly chart, well, the euro's actually opened up a little bit lower this morning. It's got a small gap lower. If we look at the 1-hour charts, it's kind of, that's Friday's close, and it's moved down to below to around 109.50 this morning. The hourlies do look a little bit heavy. So, but overall, I suspect that given the look on the dailies, that buying dips might be the go for now. Having said that, though, if we look at the Ichimoku chart, we did try and get into the daily cloud on Friday. That got rejected. So that's going to continue to be some decent resistance, the base of the cloud. The top of the cloud currently sits at sort of 110.60. That's above the 200-day moving averages to 110.30. So there's going to be plenty of resistance in there. If we can get above 110.60, then I think 111 is possibly on the cards. It could be, though, that we just we're continuing this sort of choppy sideways trade for the time being. While I'm on the dollar, I'll just look at the Aussie. That's coming under pressure again this morning. It closed at 64.15 or so on Friday, down at 63.80. 4-hour charts look heavy. The dailies are certainly topping out here. We had this good rally. They look to be topping out, but without any huge momentum. I wouldn't be surprised to see a test of the 55-day moving average down around 63.30. And I certainly don't think for the time being we're going anywhere close to the last week's high, 65.60. Where the 100-day moving average is. So once again, selling rallies for the time being, looking for a test of the downside. I'll just go and have a look at Ichimoku Aussie chart while we're here. Right, well, we got above the Tenkan here, and we're now back below it at 64.05. That's going to become resistance, and I think we could well head a little bit lower. We're probably still well under it on the weekly cloud. Yeah, we're miles away from any resistance, so the weekly Ichimokus are irrelevant at this point in time. But like I say, selling rallies in the Aussie currently does seem to be the way to go. On the crosses, the interesting chart here on the crosses is in Euro Yen, which to me that looks potentially bullish. We had a key bullish weekly reversal with the higher close on Friday. Now we're opening up a little bit below that this morning, but we did make a new trend low and close towards the highs, so that looks positive. I just think with the bullish divergence that we're seeing in the weeklies, that maybe we might push a little bit higher. But this being a weekly chart, it's going to be slow progress if we do head higher. And of course, the yen itself is very susceptible to changes in risk sentiment. So if things start to look even bleaker than they already are, the yen's going to be in demand, and this will probably be snuffed out fairly quickly. But for the time being, buying dips is my preferred way to go. Elsewhere of interest, keep an eye on the oil market. West Texas Intermediate is it looks as though it's trying to turn higher on the dailies. The weeklies still look pretty bleak, and so do the monthlies. But the dailies do look constructive. I think at the moment, if we can get above this sort of 2050 level and hang in there, we could see quite a squeeze to the top side, so $25, maybe up to this level here, this high here. Where's that? 26.70. We really need to get above here, though. Like I say, the dailies do look constructive. But there's this huge oversupply and lack of demand, so this rally may fizzle out pretty quickly. I wouldn't get involved now. I'd want to see a daily close above $20. But the weeklies still do look negative. Maybe it's a sell-on rally rather than trying to buy it here. But the swings are pretty wild, so we need to keep leverage at fairly small levels. There's plenty else going on, but I don't want this video to be too long, so we'll leave it there for now. I may do another video during the week if anything interesting develops, but right now keep leverage tight and stay nimble, I think, is the plan for the time being. So until then, we'll talk later in the week. Cheers.